Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be back on the show. I'm looking out the window in Edmonton at 5 or 6 centimeters of brand new snow. It looks beautiful and white, and the trees are all covered with white.
Oh, well, the Vancouver area just went through a windstorm with winds over 90 Ks.
I'm glad we didn't get that.
Don't forget, you guys get our weather a day later.
Uh-oh.
So, that nice blanket of white might kind of blow around a little bit. Central banks, do they really run our economies or not?
Well, the main tool that the central banks use all over the world is interest rates. They have also something they use called quantitative easing, where they buy and sell mostly mortgages and bonds. But the main tool, which has been going for 40, 50 years now, is interest rates, and they set the interest rates really high when they want to slow the economy down, and they set the interest rates really low when they want to speed the economy up. And the problem with that is a professor in England, Professor Werner, W-E-R-N-E-R, he's got lots of podcasts on the internet, people want to listen to him, has done some empirical studies, starting with Japan, and has proven that the causation actually goes the other way. So when the economy is growing quickly, interest rates rise, and when the economy is slow, interest rates fall, and the central banks don't really control it as much as we think. Now, we probably need to think that the central banks are in control, because, oh my God, if nobody's in control, then it's just chaos, right? But in reality, the central banks probably have much less influence over things than we think. And in the beginning, and central banks have only been around for about 100 years. In the beginning, all they really were a mechanism where the government could stop a bank run by delivering a bunch of dollars or whatever currency in a Brinks truck to the back of the bank. So when the lineup was at the front of the bank with all the people wanting to withdraw their money, and that way they'd stop a panic in a bank run, and that was because that was before the central banks were created. That was the main problem with banking, was that they periodically would get these bank runs, and the banks would fail, and then there'd be tremendous disruption. So, but then the central banks went beyond that mandate and started to, or at least the government asked them to, start to become the masters of the economy. And I think Greenspan was the biggest perpetrator of that myth. And people called him the maestro, and he was revered for a while, and people thought he was able to magically somehow control the economy. But new research by Professor Werner shows that that's actually incorrect, and it's more likely that the reason interest rates have been so low recently is not because the Bank of Canada or the Bank of England or the U.S. Bank, U.S. Federal Reserve, has dropped them. It's because the economy being so slow has caused interest rates to drop. And that leads to a whole bunch of new implications for how we should manage banking and things like housing bubbles and debt bubbles.
Well, doesn't this basically tell us that what most people in the business will say, the market sets the rates, not the government, not the central banks?
Yeah, I think that's right. I think now there is quite a key role for the commercial banks, and that is that they actually create the money, as we've talked before. And again, the same economist, Professor Werner, has done empirical studies on that and shown that commercial banks are able to create money basically at the stroke of a fountain pen when you go in for a loan. So his research is focused more on the quantity of money rather than, so the interest rate being the cost of money is not as important as the quantity of money that's available. So I may have told you the story about being in a bank branch in January and describing a young couple that I know and asking how much they could borrow, and the bank officer said, $1 million, no problem, depending on the down payment. So that we didn't even talk about the interest rate on the mortgage. I guess it would be 2 or 3%, but it would be the quantity of money, and that of course leads directly into house prices and everything else. So I think that it's not entirely a free market in the sense that when the central banks are able to create money out of thin air and offer enormous quantities of money, that has a direct impact on asset bubbles, especially in the housing market, but also in the stock market. And then the government is left to mop up the damage after the bubble bursts. And Greenspan actually talked about this quite a bit. He said that, because central banks can't predict what's going to happen, and because he believed that governments shouldn't control the market, he seemed to be saying, without quite spelling it out in so many words, that the government's role is to go and mop up after the storm and try and fix which of course is what they did in 2009, 2010. They went in and bailed out Citigroup, Bank of America, General Motors, Chrysler, and AIG, and a bunch of corporations because of the damage that the global financial crisis caused. So that seems to me to be a flawed way of doing it, in the sense of the preferred way would be to stop these bubbles from forming in the first place, and then we wouldn't have to worry about the damage caused by the bursting of the bubble.
How could you stop the bubbles from forming?
So it would be the quantity of money. So if you put a restriction, for example, going back to those commercial banks creating money out of thin air, if you put a restriction on how much they could lend, because from the bank's point of view, they're doing what they should be doing, which is they've got shareholders. They want to show growing assets, growing revenue, and growing dividends. And they've been very successful for more than 20 years now. But from the point of view of society, the debt load that is created by all of that activity is a negative, if anything, if there's ever another recession, and of course there will be another recession. So we do have a regulator, OSFI, and we do have a central bank in Canada, the Bank of Canada, and we do have a government. And all of those things, in order to protect the stability of the financial system, could put some rules in. And I think that's what they're trying to do now, to rein it in a little bit, so that, young couples aren't borrowing $1 million and then defaulting on that loan down the road. So you'd have to put in restrictions that said you couldn't borrow more than 3 times your annual household income, for just to pick a number. And so in the case of that $1 million loan offered to that young couple, it would probably be more like $300,000 or $400,000 loan offered to them. And we won't know until we try it, and I don't know if we'll ever try it, but my guess would be that the house prices would adjust downwards to meet that limit that the bank was willing to offer. But we wouldn't know unless we tried it.
Isn't that what we're doing with the new mortgage rules that go into effect in the new year?
They're tiptoeing in that direction. That's right. They are. Now it seems like, and it's shocking to me because when I wrote the book, I had to do a lot of research on this stuff. But it's just amazing how you close up one loophole and then another loophole immediately appears. So loopholes that I didn't know existed even after doing all the research. And so it turns out that when they closed up a bunch of loopholes to do with CMHC, then everybody just ran over to the non-CMHC area, and that's why lately the OSFI brought out these new rules on October 17th for the non-CMHC market that said they have to be tested or qualified the same way the CMHC mortgages are qualified. But it turns out now that the banks have more flexibility in terms of beyond even that, so they can offer 35-year amortization and they can do a bunch of stuff. So now, if they keep doing that, they run the risk of offending the regulator. And because the regulator obviously in everything that you read that they put out says we don't want keep lending people these massive amounts of money. They want you to slow it down. So you'd think that the banks would be a little bit afraid of the regulator, but maybe not. Maybe maybe they're not afraid. But yeah, they as you say, they close one loophole and immediately everybody rushes over to another loophole. And whether the OSFI and the other people can close that very last loophole remains to be seen.
Well, anything invented by a human can be circumvented by another human, I would think.
The ingenuity, it's exactly right. I think what happens is, it's exactly right. The rules can be circumvented, but what might happen is the willingness to look for that last loophole might disappear if the senior people in the lending industry, both in the banks and the non-bank sector, get frightened. And because it goes through periods where you get enthusiasm and then you get caution or outright fear. In that, we haven't had a cycle where the senior people are afraid of making a mistake and afraid of losing their jobs, afraid of being criticized for making a bad loan. But it probably will happen. We had a bankruptcy in Alberta here. One of the largest home builders went into receivership, not bankruptcy yet, but and the loan owed to a major Canadian bank was $64 million, and it's just astonishing to think that a home builder, who are notoriously risky in terms of borrowers, was able to get into, in this case it was the Royal Bank of Canada, for such a large sum. Because when they try to liquidate the collateral behind that, you're talking 64, you're talking a huge number of houses that would have to be sold in order to get that money back, and it's going to send ripples through the whole economy. So there's a lender somewhere within that organization that's going to be criticized for having allowed that one builder to get so deeply into debt. And that'll have the effect that all of the other people that work for that organization, plus all the people that work for the other banks that are in similar positions, will notice, how bad that guy looks or that girl for making those loans, and they'll all adjust their behavior to a more conservative stance. And it could have been predicted quite easily when 2014, when the oil price dropped from $100 down to $30.
But we don't know when the loan was issued. Maybe it was issued at the height of the Alberta oil boom.
Well, those kind of loans, though, they're operating loans, so they're supposed to fluctuate up and down, right? So the business person has to buy a bunch of materials, has to acquire some land, has to get advertising and all that, and then they sell a few homes and they pay down the loan and stuff. So obviously that loan must have gotten bigger and bigger and bigger over time, and nobody ever stepped in and said, okay, and maybe the reason was that they didn't want to put them into bankruptcy by telling them they couldn't borrow anymore, so they just kept lending them more and more money. I don't know if we'll ever know, but it just takes one or two mistakes like that by a senior lender, which look like mistakes in hindsight, to affect everybody else and cause them to dial it down a notch or two. And that's all it takes. Like that, that's just at the margin. People just being slightly more cautious in the amount of credit that they're offering. Going back to what we started talking about, it's the quantity of credit that matters more than the cost of credit.
We'll have more with Hilliard MacBeth right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. please visit our website at arcticstar.ca or call us at 604-689-1799.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, the new rules were supposed to, I guess, control the real estate bubbles in Vancouver and Toronto, but a new report from CIBC indicates it's probably not going to do that.
Well, it's a very optimistic report, and it's quite interesting because we were just talking about the loopholes and what the conventional mortgages versus the insured mortgages, and an economist with the leading organization, which is CIBC, in the non-insured mortgage space, came out with a report saying that Toronto, Montreal, after a brief pause. Now, I haven't seen the whole report, but the headline says, after a brief pause, Toronto and Vancouver house prices will continue to rise indefinitely. And the deputy chief economist, Benjamin Tall, said the two most expensive cities will flatten or even soften next year, but the slowdown will be limited by strong demand. If you think those cities are unaffordable now, just wait. I think that from a long-term perspective, everything we're doing is temporary. The fundamentals are way too strong, offsetting all of that. So what he's saying is these changes in the rules will not be enough to rein in the housing markets in the two most expensive cities in Canada, and after a brief period, the bubble will resume. And you know, he's could be right in the sense that if the bubbles don't burst, then they have to keep growing bigger. There's no leveling off. There's no soft landing possible with Toronto and Vancouver. It's either one or the other. And of course, the organization CIBC has got one of the biggest books of mortgages in the non-insured portion, so they've got a lot at risk. So you could say that he's hoping that that's the case, but I'm sure he believes it, as do the majority of people believe that house prices can never go down. But it is a little odd to see a senior economist with a major lender making that prediction, because the past prices for houses in those cities are much lower than they are today, and the prices in similar cities in other parts of the world are also more affordable than those. Those are two very, very unaffordable places to live right now. And I'm not sure what he means by demand. I don't know if he means people moving there, or he mentions students. I know students seem to have a lot of money in Vancouver. They're able to buy very expensive homes. $13
million compounds, yeah.
But I wouldn't want to, like if you were starting up a business and you were saying, okay, we're going to invest, millions and millions of dollars, but it's all going to be based on the possibility that some rich students will arrive from a foreign country and buy our houses. It just sounds like a risky thing to do. So,
well, those same students are racing Lamborghinis around downtown Vancouver.
Exactly. He also mentions foreign workers, but like foreign workers generally, what we had in Alberta anyway, is they tend to be fairly low income. At least they start out at the low income range, and then if they get an immigration status, then they often will send their children to university, and then eventually they become very high income people. But it takes a 20 or 30 year cycle before that happens. So I'm not quite sure who these people are that are arriving with the money. And the other thing that just what we were talking about a minute ago, the expansion in household debt in Canada, and most of that is Toronto and Vancouver, and Calgary and Edmonton are the four big places for it, proves that it's not a whole bunch of foreign students with gazillions of dollars arriving on our shores to buy these houses. It's people borrowing money from the Canadian lenders that are putting up most of the money to buy this housing. So it doesn't actually work, because as the house prices go higher and higher, the banks have to create more and more money by making new loans, and the rules are going exactly in the opposite direction. So it's a very, very difficult situation, and it's really impossible for it to continue to grow at the rates that it's been growing at. So Now, one of the loopholes that is not covered by the new rules, and it's mentioned in the story, is mortgage investment corps. So there are lenders that are not covered by the OSFI rules and the CIBC rules and any of those rules. And these are called mortgage investment corps. And what they are basically are rich people, probably baby boomers with a bunch of money, putting money into a corporation that then turns around and relends it out to some home buyer that can't qualify under the current rules. So it's a highly risky business, and it's dependent on very few defaults, because as soon as there's any defaults, the rich people will back away very quickly. And it's also the problem with it is that the cost of the loan is quite a bit more expensive. So instead of 3 or 4% mortgage rates, we're talking about 7, 8, 9% mortgage rates in that mortgage investment corp world. And that becomes extremely difficult as house prices go up and up and up. And the mortgage investment corps cannot create money out of thin air like the banks. They actually have to have that deposit from the investor first before they can lend it out again. So it's limited from that point of view as well. So it's just hard to see how this thing can keep going if prices get too high, if wages don't, and they obviously haven't kept up, and if the banking rules are tightened by the amount that they appear to be tightening.
We'll have more with Hilliard MacBeth right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Hilliard MacBeth. Hilliard, the International Energy Agency predicts that by 2040, the world will be using 105 million barrels of oil a day, up from the 90 million a day being used now. I thought we were supposed to see declining consumption of oil because places like Europe have mandated electric cars by then.
Well, that actually is a pretty slow, and that's basically a big reduction in their estimated demand growth, because you've got countries like India and China that were expected to, where very few people have automobiles. And those two were expected to grow the oil and gas consumption quite dramatically. So that what they've done is they've adjusted their estimates lower. They also talk a lot about electric cars in that report. It's a very interesting report. It just came out, and they say that there's currently very few cars, about 2 million electric cars, and I think that includes hybrids. And by 2025, there'll be 50 million electric cars. And by 2040, there'll be 300 million electric cars. So that is still allows the oil consumption and demand to continue to grow right up to 2040, which is kind of surprising. But to give you an idea, 50 million by 2025, there's 1 billion automobiles in the world. So it's only 5%. And so there's still 95% of all the automobiles will still need to go to that service station and get some gasoline or diesel before they can continue. So, but the other big thing that report, and I think this is the really big one, which has caused the oil price to drop today, is not on the demand side, but on the supply side. And they are estimating that U.S. crude oil, which is primarily shale oil, is expected to peak in the mid-2020s at 17 million barrels per day, which is just phenomenal, because right now shale is about 9 million barrels today. So they're saying there's going to be another 8 million barrels added just out of the U.S. alone. I suspect all of it will come from shale. So this is a game changer for a lot of people. Canada, for example, is right on the forefront of that because Canada exports 3.5 million barrels a day to the U.S. They're currently importing about 7.5 million barrels. So Canada's getting almost half of they're buying almost half of their oil that they import from Canada, mostly heavy oil from northern Alberta. But if the U.S. increases its production to 17 million barrels per day from the current 9 million barrels a day, I don't really see where they need to import any oil at all. And that's just that's just going to, it's not just Canada, but Saudi Arabia, Mexico, all these countries all over the world are going to be disrupted in a very big way if the U.S. actually is able to increase the production that quickly.
Well, what does that say for Alberta? Is that why it's so important to get a pipeline out to the West Coast and start shipping oil to Asia?
Well, I think so, because when you think about it, so the U.S., which is our best customer right now, we're selling 3.5 million barrels a day, which is a huge, it's our biggest export by dollar volume. And Canada, as you know, is dependent on exports for its economy. Our biggest customer is about to become our biggest competitor. So we need to now we started a minute ago talking about the energy demand is going to continue to increase till 2040, but it's not going to be cars in the U.S. and Canada. It's going to be cars in India and China and places like that where they don't have as many vehicles yet. So we need to get access through other means to be able to sell directly to those markets, or I suppose we could export to the U.S. and then the U.S. could re-export it and there is some of that going on already, I think, because while the U.S. is importing 7.5 million barrels, they're actually exporting a little bit. I don't know exactly the numbers, but but they would probably prefer to export their oil that they produce themselves more than the oil that they've imported from Canada, and our Canadian oil would have to be priced cheaper than their local domestic oil in order for that to work. So we'll either have to reduce our volumes or find new markets with new pipelines, or cut our prices quite a bit, and or a combination of all of those things. But it's going to be very, very challenging. And the IEA could also be wrong in terms of maybe the electric car will have more. I know in China, for example, because of the pollution being so bad, they're putting on a huge push for electric cars beyond what was anticipated even a year or two ago.
Well, they could always put them back on bicycles again.
I think a lot of them still are on bicycles, but it seems like they go from bicycle to scooter, which gasoline, and then to car, but maybe they're going to skip the scooter and the gasoline car and just go directly to electric, and straight from bicycle to electric vehicle. That would.
But if they're using coal to power if they're using coal for the power generation, they're not going to save anything on air pollution.
No, but it is. It would actually be less. I think it would be less polluting because they can control the pollution from the coal-fired plants, put them away from the big cities, and have better control on scrubbers and all that. Than having the individual cars, and also the electric mechanism is more efficient, so they don't lose as much heat through electric cars as they do through regular automobiles. So even if it was all coal-fired, which is not going to be, obviously, because they've got other solar and nuclear that they're working on, but even if it were all coal-fired, it would still be better to skip the car with the gasoline engine part. And but I don't know if they will. China's the big one. It looks like they're heading towards electric faster than we thought. I know Europe. I just read a story the other day that Europe is talking about having a standard recharging technology all across Europe, all 500 million people. I haven't heard anything about India yet. So India's the big one. And
Britain's putting in what they call the Greenway, They'll have a green lane where your electric car will charge as you're driving on it.
Yeah, I don't know if that would work in Canada with all the snow and that.
Good for the summer. Hilliard, Thank you so much for chatting with us.
Nice to talk to you again.
My guest has been Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, macbethgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.